So imagine watching a stock lose over 70% of its value in just a single month. I mean, most investors would absolutely run for the hills.
Oh, without a doubt. It's a
Yeah.
panic scenario.
Right. So why did institutional investors suddenly just inject $15 million into this company right as the major insiders were sprinting for the exits?
That contradiction right there is the defining puzzle of this particular asset. You have smart money actively placing massive bets on both sides of a potential collapse.
Yeah.
And it creates this crazy tug of war that honestly leaves retail traders caught right in the crossfire.
Okay, let's unpack this. We're looking at Battalion Oil Corporation today, ticker symbol BATL. It is April 28th, 2026, and we are digging through this massive stack of recent SEC filings, market data, and analyst outlooks.
The goal here is really to figure out if you're looking at a deeply misunderstood hidden gem or just a dangerous value trap that's about to swallow your capital whole.
Exactly. But before we get into the actual mechanics of this company's debt and the market psychology, you just want to quickly remind you listening that this is strictly an intellectual exploration of the financial data.
Right. We are just breaking down the how and the why of these market movements. This is absolutely not financial advice.
Definitely not. So let's jump straight into the sheer whiplash of this price action because, well, before anyone even opens a balance sheet, the psychological state of the market is painted right there on the chart.
It's unavoidable.
Yeah, so Battalion is currently sitting around $3.38 a share. And if you just log in today, you see it's up over 10%, which looks great.
Wait, a nice green day.
But you zoom out, and the reality is brutal. It's down an agonizing 73.49% over the last month alone. And the 52-week range is just staggering. It goes from a high of $29.70 all the way down to a low of $1 flat dollar.
I mean, a drop from $30 down to $3 fundamentally breaks the shareholder base.
Oh, completely.
The long-term institutional holders who bought in at $20, they're likely gone. They triggered their stop losses weeks ago. So what you have left is this highly volatile mix of trap bag holders who are just hoping for a miracle and aggressive day traders looking to scalp a quick bounce.
I have to push you on that daily bounce, though. When a stock falls that hard and suddenly spikes over 10% in a single session.
Like it did today.
Right, like today. Is that just a classic dead cat bounce where short sellers are temporarily covering their positions, or are buyers actually seeing something that the panic sellers completely missed?
To answer that, we really have to track the liquidity. We need to look at who is actually moving the volume right now.
Okay.
And in early April 2026, the data shows massive insider selling. It's a huge red flag. We are talking about Luminus Management, LLC, a major shareholder, and they dumped approximately $8.6 million in shares. Yeah. When the entities with the absolute closest, most intimate view of the operations are aggressively offloading their positions at these depressed levels, well, it sends a chilling signal to the broader market.
I mean, I'm looking at that and thinking, if the insiders don't want to hold this at $3, why on earth would I?
Exactly.
But then I see the institutional data from just a few weeks prior, back in March. Institutions actually stepped up and bought into a $15 million securities purchase agreement.
Right, the SPA.
How does that make any sense?
Yeah.
You have institutional capital being injected to bolster the company almost in the exact same window that major insiders are basically bailing out.
Well, it comes down to the structure of the deal and the motivations of the players involved. Luminus might be engaging in tax loss harvesting, or, they might genuinely believe the equity is going to zero.
Sure.
But the institutions injecting that $15 million, they aren't just logging onto a brokerage and buying common stock on the open market like a regular retail trader.
Right. They're getting special terms.
Precisely. Securities purchase agreements often come with warrants, convertible notes, or highly favorable liquidation preferences. They are structuring their investment so that if Battalion goes bankrupt, they are first in line to pick the bones clean.
And if the company survives?
Then they get a massive upside multiplier.
So the fundamental picture is completely fractured. And to understand why those insiders are running while the institutions are building these complex lifelines, we have to look past the ticker symbol. We need to look under the hood and directly into the company's accounting.
The financials tell the real story here.
And honestly, looking at their income statement, I am struggling to find the bright spot.
Yeah.
If we look at the trailing 12 months, total revenue is $166.04 million.
Which is actually down from about $193.89 million back in 2024.
Right. And the operating income is negative $5.56 million. Net income is negative $36.83 million,
Yeah.
and their basic EPS is deeply in the red at negative $2.24.
It's heavy bleeding. For every dollar they make, they are losing money.
But here is the thing that completely shocked me. The balance sheet. I'm looking at this metric, and their common stock equity is actually negative $32.79 million.
Yeah, that's the jarring one.
Wait, how can equity be literally negative? As a regular retail trader, if my account goes negative, I get a margin call. My broker liquidates me on the spot.
Exactly. You don't get to just operate in the negative.
Right. So how does a publicly traded company with a $69.53 million market cap operate like this?
Think of the company's assets like a pie. Battalion actually has quite a large pie. They have $460.68 million in total assets.
Okay, that sounds decent.
It does, but the common shareholder does not own that pie free and clear. Because you have the debt holders who are owed $220.33 million. They have the absolute right to the first massive slice.
Thank you, man.
Then you have the preferred stockholders who have over $226.24 million tied up in preferred equity. They get the second slice.
Wow. So by the time you get to the common stock, the actual ticker symbol that regular people are buying on their brokerage apps,
There isn't just no pie left. There is essentially an IOU for the bakery.
that's insane.
Common stock equity going negative simply means that the accumulated losses over time have entirely wiped out the book value of the common shares. The debt and the preferred obligations exceed the total assets.
So the common stock is technically worthless on paper right now.
Unless the company can magically generate a massive surge of free cash flow to shrink that debt pile, yes. If we connect this to the bigger picture, you're buying a highly speculative call option on the company's survival.
Speaking of survival, there is one lifeline I noticed in the cash flow data. Battalion does have $27.96 million in total cash right now.
They do, but we have to look at how they got it.
Right, they didn't earn that from selling oil at a huge premium. In February 2026, they aggressively sold off their West Quito assets for $60.1 million.
Yeah, they parted with core assets.
And the filings show they immediately turned around and used $40 million of that cash to prepay debt.
That is a classic triage maneuver. When a company sells off revenue-generating assets just to pay down debt, they are sacrificing future earning potential just to guarantee their survival today.
It's buying time.
Exactly. It shows management is acutely aware of the massive capital structure pressure. That $15 million institutional purchase we discussed earlier, that was just another triage move to secure immediate liquidity.
So, knowing the fundamentals are weighed down by heavy debt, but somewhat buoyed by these aggressive asset sales, we have to turn to the technical indicators. We need to see how the market is mechanically pricing in this tug of war.
And the technicals are a mess right now.
Totally. I'm running through the bearish indicators first, and it's bleak. The MACD is negative, sitting between negative 0.38 and negative 2.0, showing a very clear bearish trend.
Right, the momentum is aggressively downward.
The 20-day simple moving average is pointing down. And the price is sitting really uncomfortably below the 200-day SMA, which ranges all the way from $3.01 up to $8.17.
The long-term trend is undeniably broken.
But then you have these crazy reversal signals. The RSI is sitting neutral, around 37.8 to 51.9, and it's approaching oversold territory. And the stochastic indicator, which is anywhere from 4.77 to 15.8, is actively screaming oversold, basically flashing a buy signal.
Right, which creates a huge cognitive dissonance for traders.
It feels like driving a car where the GPS is screaming, turn around, you're heading for a cliff, but the engine temperature gauge says, we're finally cooled off, time to floor it.
That is a perfect analogy. The oscillator indicators, like the stochastic, they aren't necessarily saying this is a fantastic company to buy and hold forever.
What are they saying then?
They are saying the downward selling pressure has exhausted itself for the moment. Everyone who wanted to panic sell has already dumped their shares.
Got it.
And when selling pressure evaporates like that, even a tiny amount of buying volume can cause a massive spike, like we saw today.
Which makes the support and resistance levels absolutely critical.
The absolute key level to watch for short-term weakness or strength is the strong support zone between $3 and $3.19. That's based on recent lows.
Okay. And if it breaks that $3 floor?
If it breaks that, it enters a dangerous falling channel. There is very little historical price memory below that level to catch it.
So it's basically a free fall.
Exactly. On the upside, if this bounce has legs, immediate resistance sits at $3.50, then $3.68, and a much heavier ceiling at $4.20.
So with the technicals flashing these extremely mixed signals and the fundamental debt looming so large, we hit the ultimate debate here. Is this stock a deep discount, or is it a classic value trap just waiting to snare retail investors?
Well, the analyst consensus is brutally cold right now.
Yeah, they're showing no mercy. The ratings are currently strong sell to hold across the board.
Wall Street wants nothing to do with it.
Yet, if you look at a basic screener, Battalion's price-to-sales ratio is just 0.9x. The average for their peers is 1.x. Technically, it looks incredibly cheap.
And that right there is why retail traders often get trapped. The volatility is a huge magnet for day traders.
Right.
But the downside risks are basically existential. A value trap occurs when a stock appears cheap by traditional metrics like PS, but is actually priced correctly because of the structural rot underneath.
So what does this all mean for their actual survival?
It brings us to the most crucial detail of this entire deep dive. The market skepticism remains astronomically high because to comfortably service their debt, Battalion heavily relies on forecasts of high oil prices.
How high are we talking?
Specifically around $110 per barrel.
Oh, wow. Wait, really? $110?
Yeah. If oil drops, or even just stabilizes around $70 or $80, their debt becomes a crushing weight. They don't have the margins to survive it.
That is terrifying.
Add in the fact that we saw recent board member resignations in April 2026, and the risk profile just skyrockets. When board members step down during a debt crisis, the market takes notice.
Okay, to give you listening a complete, balanced perspective, we need to crystallize both sides of this. We need the best-case recovery and the worst-case continuation lower. Let's start with the bear case.
The bear case is a classic dilution death spiral. The short-term and long-term outlook here is that the heavy burden from those term loans and the massive preferred stock interest forces constant share dilution.
Because they don't have the cash to pay the interest.
Right. The company has to keep raising capital just to stay afloat. And that constantly erodes shareholder value until that $3 support breaks entirely.
Okay, let me play devil's advocate and build the bull case. Because there are upside catalysts here. First, Battalion just closed an all-stock acquisition of assets in Ward County in March.
Which is smart. They used equity instead of their limited cash.
Exactly. Plus, they're seeing real operational efficiency. Production in their core assets has actually increased by about 30%.
And they did that with minimal capital, which is very impressive.
Yeah. They are also hitting record throughput with new midstream partners. So they are getting the oil out and moving it much more efficiently.
The operational turnaround is a very real factor, but both the bull and the bear scenarios are about to collide.
Right, because both of us agree the short-term outlook hinges entirely on one upcoming catalyst.
The earnings report on May 13th, 2026.
Everything is riding on that date.
That report will reveal if the operational efficiency is enough to outrun the debt interest.
So to synthesize this entire deep dive, Battalion Oil is a high-stakes battleground. It is a company restructuring its debt on the fly, showing flashes of real operational brilliance, but burdened by a horrific chart, insider selling, and a massive reliance on premium oil prices.
It really is.
And we wanted to bring this to your radar because it's a masterclass in how a cheap stock is rarely just cheap. There is always a complex mechanical reason why the market has discounted it.
Oh, for sure. And I'll leave you with a final provocative thought to mull over.
Let's hear it.
If a company's survival is implicitly tied to oil hitting $110 a barrel, are you really investing in the company's operational turnaround? Or are you just buying a highly leveraged lottery ticket on global macroeconomic conflict?
Wow. That is exactly the question to ask. Thank you for joining us on this deep dive. Stay curious, keep questioning the numbers, and we'll catch you next time.